Hey, what's really good, fam? Today is October 30th and it's officially been 2 weeks since some next man's got lit up like dynamite. Prayer hands for anybody who lost big on that massive IPO and a devastating learning experience for a good number of people entering the market for the first time. Today, I want to talk about Big Hits IPO, why I didn't buy in, and the nature of IPOs as a whole. You're watching Sekkider, and this is an essential topic to get familiar with. How not to eat shit during an IPO. Before I keep going, please do me a favor and like this video, then subscribe to the channel if you're interested in more content like this. Now let's get to work. Alright, so in the lead up to the IPO of BTS's managing group Big Hit Entertainment, I saw mad articles about the hype surrounding the opportunity to buy into the company. From local news desks to Al Jazeera and the New York Times, everybody was talking about the new way to get a little piece of Korea's greatest pop culture export. In the days since, however, those same news desks have been dropping articles about the entertainment group's crashing stock price faster than the ticker itself. On top of that, there are a lot of testimonials all over Naver about people who didn't even know anything about investing, who decided to get into the market specifically because of the fanfare surrounding the biggest Kospi IPO and the biggest year of Kospi IPOs. Now I'm gonna break down what happened, why it happened, and how easy it was to see coming if man just took the time to look. Alright, to start, I want to define what an IPO is and talk about why companies IPO in the first place. Alright, the acronym IPO stands for Initial Public Offering, and it refers to the first time that a company allows regular people like you and me to start buying ownership shares. This process is sometimes referred to as going public or simply as the initial offering. To demonstrate this, let's create a new company. I'ma call it Big Hot Breadtertainment. Alright, Big Hot is a company that's been around for a few years. They entered an already saturated market, but they have this really new hot product called Bangtan, and it's worked its way up the breadboard top 40 and has an army of fans who just really love their bread. Up to this point, the company has been owned and operated by a CEO, let's call him Bread Boy, and a few institutional and angel investors were also in the mix. Basically, it was just people who invested in the company heavily when it was still a small private operation. Up until now, it's been impossible for regular people to own even a fraction of Big Hot without buying privately and directly from one of those private investors. Now, however, Bread Boy and his ownership group think it's time that the public has a chance to buy into the company. They plan an IPO date, take pre-orders, and ballpark the opening price of each share. Now let's ask the most important question to ask during an IPO in general. Why would they do that? Well, there are a few reasons that a company might IPO. For example, maybe the company plans to launch a new product similar to Bangtan, but maybe they don't have the funds to do so at the moment. Maybe they need more people to recruit unique talents or manage the people they've already found. Maybe they need to develop a new marketing campaign or build a new building to help expand their operation. By selling new shares to the public, companies are able to raise an immense amount of capital from people who really just want to own part of the company. IPOs are like that scene in Shark Tank where the entrepreneurs ask the rich people for money and negotiate a price and percentage. The main difference though is that in the case of an IPO, it's the rich people that are doing the selling and the percentage of ownership is already determined. This is a little bit tenuous since overpricing the stock may reduce interest and could lead to a disappointing IPO. There are, of course, other reasons to IPO. If, per se, the current owners of the company see that they're at maximum profitability and want to cash out while Bangtan is at the top, they could simply just dump their shares, take their profit, and move on to a new company to invest in. This is actually the way that angel investors work, where they just give a lot of money to a small operation, wait for it to go big, and then sell off and then move on to a next operation. Anyways, Big Hot puts out a press release a month before the IPO and sees that the demand is absurdly high. Knowing that all shares will definitely be sold, the company prices their shares at the upper limit for IPO day. As the day nears, news outlets from all over the globe release articles about this hot new stock, and public investors line up to buy their shares. In an ideal world, the company takes the money, reinvests in the company, and the shareholders maintain demand for the shares of this incredible new company. But this is not always the case. See, institutional investors not only know but rely on the fact that the average retail investor, someone like you or me, is often really unsophisticated in their process. During the press release, a lot of die-hard fans of Bangtan even went on record saying that they had no understanding of stocks and were just buying because it was somehow related to the product. Some even said that they were just buying because of the hype around the stock and it was just too big to miss out on. High demand at maximum prices are an institutional investor's dream, especially if they know that they're selling at a price significantly higher than the stock's intrinsic value. That is to say, the price of the stock is stupid high for reasons entirely unrelated to the product itself. Alright, so the bell rings and the first orders are cleared at max price. But as stock owners race to sell off their extremely overpriced shares at the height of their value, it becomes a buyer's market. If everyone is selling at say $3.50 per share, the person who sells at $3.49 will likely have their shares bought first. The next person, happy to be selling at $3.45 since it's already overpriced anyway, they'll go ahead and sell it at that. What's $5K if you're already making mad money off your initial investment? Sellers competing to pass off their shares start accepting lower bids, and before you know it, the stock price has dropped a full 20%. On the side of the retail investor who now sees the price falling rapidly, it becomes more ideal to buy cheaper, so they demand cheaper and wait for sellers to break. Very quickly, this extremely overpriced stock starts to roll downhill. Retail investors who are now watching the value of their investment plummet might aim to cut their losses by selling on the same day, keeping up that downward momentum. Meanwhile, the company and its initial owners see nothing but profit, because here's the thing that most beginner investors miss about IPOs. Companies only make money on the initial sale of shares during their IPO. Everything after that is simply the buying and selling of those shares amongst investors and institutions who will often simply pocket whatever profits they gain from the sales. Now, those same investors who cashed in on the IPO can buy the same stock back as the stock's price drops closer to its intrinsic value. Now, I don't know if that's what happened with Big Hit, but that's kind of what I saw coming and that's why I didn't buy it. See, as a value-oriented investor, my goal with investing is to buy shares of quality companies that are being sold well below their worth. On top of this, I also aim to buy growth stocks in companies that I think will continue to grow and expand as time goes on, but only when they're priced reasonably. Then, after buying those shares, I just wait for the market to realize their oversight and correct the company's price to fit its intrinsic value, at which point I reevaluate and decide whether or not to sell or continue to hold. With regards to the Big Hit IPO, I was out weeks before it happened simply based off the fanfare around the stock. With people clamoring to buy something they openly didn't understand, it was clear that the demand was too high and therefore the price would be simply too high for the company that I believe to be unlikely to live up to those expectations. Simply put, the company had only one product, and as massive as it was being priced at 8 to 9 times higher the face value of its closest competitors. Let's compare. On IPO day, Big Hit opened at $350K and closed at $250K. Meanwhile, YG Entertainment, who manages the second most internationally known K-pop group in Blackpink, and also has a more robust history of talent development with the OG's Big Bang on their roster, was only selling for $45K on that same day. Now, I didn't buy either of them since they don't match my personal evaluation criteria, but it does go to show that IPO hype can be so far detached from a company's intrinsic value depending on the situation. Like, on that same day, SM Entertainment, who manages notable groups in the industry like Red Velvet, EXO, and NCT, was only selling for $32K. Seeing established companies in the same industry that are main competitors priced at 8 to 10 times less than the asking IPO price, for me that's a telltale sign that the price was simply way too high. On top of all of this, private companies aren't actually required to publish annual reports, so buying during a company's IPO is kind of a shot in the dark. This is not to say that those who bought in at $350K will not see the company grow into a beast in the future if they hold on to the stock long enough, but if that takes 5 or 10 years just to break even, if ever, then that's a lot of wasted capital that could have been spent on more productive things. As a personal rule, I generally don't buy during IPOs, especially if they've been eating the headlines for weeks in advance. This just means competition will push the price through the roof, and although that means I might miss out on a few gems, it keeps me from falling for some of the more common traps and keeps my bets within a margin of safety. It's boring, but in a year of hot pump and dump IPOs, I've definitely saved a lot of money with this system. During a company's IPO, the best way to not eat shit is to stand back. More often than not, there isn't enough information to accurately assess the company. More than that, the person selling knows more about the company than you. And if they're not holding on to theirs, what does that say about the stock? One of the OG investors, Peter Lynch, said, "Know what you own and why you own it." And I always find that hard to do on an IPO day, especially in an industry like entertainment where a lot of the value is actually intangible. Like you can't buy hype, you can't feel hype. Some groups really kick off, some don't. So I wasn't gonna buy that stock unless there was clear evidence that the company had a foolproof way of consistently rolling out talent as profitable, if not more, than BTS themselves. Now, if you're one of the people who lost out on IPO day, just take this as a learning experience. Know what you're doing and why you're doing it before doing anything at all. Also, if you're still pretty bullish on Big Hit and you want to buy the stock while it's down, just make note that there are some major shareholders that are subject to 3 to 6 month long lockups, which means they can't sell off their shares until after 3 to 6 months. So we may still be a little bit farther away from the lowest price if you still want to get into the action. But look, I don't have a magic ball, I don't know what the future looks like, and nobody else does really. Stock prices lie, companies lie, people lie. But you know what doesn't lie? Numbers. So learn how to do your valuations before you go in big on any company. Alright, I'm good with that. You good? Good. Come back next week where we'll be adding to the personal finance series, and maybe I'll talk about the companies I like and why I like them. Maybe I won't. Who knows? I don't. Should I have prepared an outro? Perhaps. Why am I still asking questions? I don't know. Goodbye.